And welcome to On the Spot, the weekly series looking at the spot market. We're reviving it for FreightWaves Now. My name is Kevin Hill, here with our Director of Passport Research, JP Hampstead. It's been a while since we've done this.
It is. It's time for season 2 of On the Spot to premiere. So thanks for having me back, Kevin.
You bet. It's an interesting market to premiere that. And this is where, you talk to a lot of people in the market. We all do, but especially you, JP. You talk to a lot of 3PLs, freight brokerages, and talk really about spot market conditions, what they're seeing right now. So tell us what the spot market is doing right now.
Yeah, I mean, we have a basic chart that we can pull up that really illustrates the kind of fundamental dynamics. I know that Zach just spoke about how tender rejections have finally are tracking now below 2018 levels. If we look back at June 2018, such a long time ago. But they're still extraordinarily high, 22.3%, slowly gliding downward as higher contract rates yield better routing guide compliance for shippers, and falling, but still very, very high spot rates, right? Still, our average sort of national basket of spot rates from truckstop.com is still showing $3.11 inclusive of fuel. But there are some things that we've been hearing from operators in the market that I think bear on how we interpret those numbers.
And those are a little bit of a softness. And
yeah.
Would you attribute a lot of that to contract rates being reset over the last few months, and some of that excess spot market freight going back into the contract market right now?
Yeah, so to be clear, we haven't seen anything in the data or heard from freight brokers that capacity is suddenly looser, or that shippers are turning off the volume. That's not really the case. It's more just about what's being moved as contract, what's going directly into the spot market. Spot capacity in some places is loosening up a little bit. We've heard from two major 3PLs that their gross margins on contracted freight are actually widening, that they're enjoying the widest margins they've seen in nearly a year on contracted freight. And one of the reason why that kind of puzzled me for a second is that we don't really see that showing. If you look at the truckstop.com numbers, if you look at DAT numbers, you don't really see that because frankly, the data can be a little dirty, a little muddied. There are some things you have to take into account when you look at it, and one of those is fuel.
Fuel.
Yeah. So you just got a smile on your face, Kevin.
I know, because one of the reasons why it's so dirty is, as a freight broker myself, the last thing I thought about whenever I'm entering in all this information into the TMS, trying to get the truck, looking at the fax machine back in the day, is separating out the accounting side and making sure that the fuel surcharge is in that bucket and the line haul rates and any other accessorials, right? I could care less. So and we always ran with all-in rates.
You're saying
all-in rates.
You're saying freight brokers aren't the most detail-oriented data entry people?
I know. It's breaking news. I'm breaking it right now on the spot in FreightWaves Now that freight brokers aren't always the most detailed people in the world.
Yeah, especially when it comes to entering data after they've covered the load, right?
Yes.
And so they think of, they tend to think about, is it $7,000 to Connecticut? Is it is it $5,000 to get me out of LA? They're not thinking necessarily about rate per mile.
Rate per mile. We had the trucking side come in to us one day and said we were selling everything by rate per mile. And that lasted about maybe half a day, because the smaller fleets and the owner-operators, they think about all-in rates. That's what they think. Yeah. All-in rates, and that's how we operated. Maybe it's not the best method, and quite honestly, I think a lot of freight brokers out there, especially new reps and things, that they have no idea that the pricing data that you find out that is dirty, that what they're entering into this TMS is actually making it to that. They don't even realize that. So.
Right, they'll look at, someone will quote a DAT or a truckstop.com rate, and someone will ask, is that inclusive of fuel or not? It's like, well, did you include fuel when you reported it or not?
No, it's all
they don't
in.
know. Yeah.
Yeah,
And so,
no idea.
And so it brings me to the next point, which is essentially that if you look at energy markets, if you look at travel, if you look at commuting, they're all on the up and up. West Texas Intermediate crude oil, the American benchmark, has continued to accelerate. I don't know if it's at $70 a barrel yet, or it soon will be, or if it's blown past that. It's kind of hovering around there last time I checked. But diesel fuel prices have gone up a lot too. And so my point here is that a significant rise in fuel costs is in some cases obscuring a softening of like a pure line haul rate. That would be kind of a better, more pure indicator of the state of truckload capacity in the spot market.
And you're attributing this to the mix between spot and contract freight and resetting rates, and not. I see a lot of mainstream media, a lot of newsletters that we subscribe to, Morning Brew, publications like that. They're clamping on to the mix shift of consumer spending, especially with the consumer data coming out, the spending data coming out down 1.4%, going from tangible goods or products to experiences. Dining, restaurants, people are getting out, doing services again. Do we see that in the spot market yet, a shift in spending or a lowering of demand or load volumes at all?
I don't think there's a sense in which shippers have suddenly realized that they have pricing power or anything like that. Mm-hmm. I don't think that's what's happening. I think that it's more just about
less volume in the spot market.
Yeah, a little bit less volume going straight to the spot market, more staying in contract, contracted carriers being incentivized to stick to their routing guides and accept tenders.
Let's talk about the LTL market.
Yeah.
Right? Big news, FedEx culled 1,400 shippers, but you have a data set that puts that into a better perspective or context, don't you?
Yeah. Well, and it just kind of, we try to think about, when this news was first reported, right? FedEx Freight cutting off 1,400 customers. First, the question is, okay, well, how many total customers they have? That's kind of really hard to figure out. Second is, what proportion of the overall volume do these particular 1,400 customers represent? Are they big customers? Are they small customers? It's kind of hard to tell. But just doing some back of the envelope math, we know from public filings that FedEx Freight does about 105,000 bills a day in their LTL network. And we kind of think that these customers, they're not huge. They're probably doing a little under 10 bills a day each. And so that gets us to call it 10,000 bills a day that they've cut out of their network. Essentially high single digits, maybe getting close to double digits. It's a really significant volume and frankly revenue impact that I don't think they would have taken were there not some other really kind of important fundamental backdrops to the LTL market. One of those is strength in parcel that's getting pushed into LTL. Strength in truckload also getting broken down and pushed into LTL. And then just the rate backdrop in general. We have a data set, a payments data set that shows LTL contract rates and especially revenue per hundredweight. If you go back on a 5-year chart of that data set, you can really see it kind of being pretty flat in 17 and 18. It's starting to pick up in the back half of 18. From about $25 per hundredweight to now where it's over 40 and $43 per hundredweight. So really significant inflation in the LTL market in the past 3 years. And I kind of think that management of FedEx Freight is kind of running out of levers to pull, right? They've been pulling the pricing lever to try to throttle volumes, protect capacity, and keep hitting their service levels for years now. And it isn't working. It's not working fast enough. And so, normally, they tend to, LTL operators tend to cut volume from their networks by doing other kind of, roundabout ways. For example, changing service schedules, changing rates, making it so that they don't appear to be the best carrier for a given piece of freight if they don't want to actually move it. But this sort of drastic thing is pretty
It is
unusual.
drastic, and we have more coming out this week on that to detail it. But this ends up for this episode of On the Spot. Catch us next Wednesday.